Hello, everyone, and welcome to The Buck Stops Here. I am Catherine Murray. Well, what a week in the markets it has been, sparked by higher than expected core inflation, 6.3%, really indicating that perhaps inflation is spreading out other than just food and energy costs. It really caused the markets to decline dramatically at the beginning of the week, with the Dow dropping over 1,000 points and a lot of volatility and, quite frankly, a lot of unknowns in terms of what the market has priced in. So who better than to get perspective from than Barry Allan? He is the founder at DMAT Capital Inc. and very, very well known in the Canadian markets and globally as it relates to his expertise in the fixed income markets, which fixed income, they're always supposed to be called the smartest guys in the room, and gals, of course. Barry, welcome, and thanks so much for joining us.
Thanks, Catherine. Really good to see you again.
Thank you. Prior to us pre-taping, just kind of before we got on, you said, what an interesting week it's been in the markets. For somebody who's been in the markets for so many years, decades, what do you mean by that?
Well, certainly whenever the Fed is going through a rate hike cycle, then volatility is always elevated. And this time is no different. But there is a lot of things that are unique about this cycle because we've never had a pandemic before, and we're not really used to the recovery and the recession characteristics. It's not like a normal recession we've had when things just get overheated and then the Fed has to hike rates. And in fact, for the last almost 20 years, the Fed has been essentially cutting rates and quantitative easing to fight deflation. And now we're back to fighting inflation. So a lot of people in the markets aren't used to that.
Well, a lot of people aren't used to it, and we also don't know how to interpret all the different factors. For example, Barry, some would say that if you look at the employment data with decade low employment, that's indicating that we're not in a recession. I mean, how do you dovetail all the different factors? Where do you actually think we are right now in the economy?
Yeah, so I think the economy is slowing pretty dramatically. But the one area that isn't showing indication of that is the employment markets. We're still almost at record low unemployment levels. Jobless claims numbers came out this morning. They were barely above 200,000, which is close to the bottom end of that range. But I think that's one of the unique things about the pandemic. There's a shortage of labor because an enormous number of people left the workforce during the pandemic for a whole bunch of reasons, some good, some bad. And I think that if you talk to companies, most of the companies are saying they're expecting to lay off people in the next year, but they're not doing it yet. And I think it's going to be one of those things where employment holds in, and then all of a sudden goes in the other direction almost violently, where you'll see some pretty big negative non-farm payroll numbers and some pretty significantly rising jobless claims numbers. But we're not there yet. And that's one of the conundrums where, it's scaring the market and making people think that the Fed has to raise rates even further than they have, which I think would be a mistake, but we'll see.
So, if we go back maybe a month or so ago when we actually saw the markets move higher, it was almost because the investors believed that we were seeing peak inflation, that the Fed would in fact have to pull it back or pause or what have you. Do you think that's going to be the case? We only have about 15 more seconds in this segment, but quick thoughts there?
Yeah, well, I think the market had it wrong 2 months ago at the June lows, and I think they've got it wrong now. And we can go into why I think that in shortly. Yeah.
Okay, we're going to take a quick break. As I said, there's so many different moving pieces and parts of the market, probably more so than we've ever seen In the past decade, since the financial crisis, we know that the Fed really lifted all areas of the market, all risk on assets. It's a different vehicle and environment now. We'll be right back. Welcome back, everyone. We are back with Barry Allan, founder of DMAT Capital Management, and as I said, a veteran in the markets. There's no doubt about that. Barry, you were saying that you believe that investors had the market wrong, or the interpretation of what was going to happen back in June when we saw the market rally, and you also think that they have it wrong now. What does that mean, or what do you think is the right way to interpret the market, more importantly?
Right. Well, 3 months ago in June, the market concluded, based on a small number of weaker economic data points, that the Fed was going to raise rates to 3.5%. So 3.5% was going to be the terminal rate. And then they had built in that once we got to 3.5%, that they were going to be cutting rates almost immediately within a couple of months. And based on that market view, the NASDAQ went up 17, 18%. The S&P went up 12 or 13%. The 10-year Treasury yield went from 3.5 to 2.5. Now, here we are 3 months later, and the market view has changed dramatically. Now the terminal rate is not 3.5%, it's 4 to 4.25. And now the market is expecting the Fed to take it to 4 to 4.25 and leave it there for 12 to 18 months. And just like the view in June was wrong, I think this one's going to be wrong too. I think the Fed will take rates to 4 to 4.25. But I think there's a lot of evidence that the economy is slowing. And I think once it starts slowing, it becomes almost self-fulfilling, and it's going to slow very rapidly. The Fed will then have the conundrum where the economy is really slowing, but inflation is still sticky. And so we'll see whether they choose inflation or unemployment at that point to target. They're clearly laser focused on inflation right now, and they're not concerned with employment because the unemployment rate is 3.6%, and the labor force participation rate has actually risen in the last month for the first time in a year and a half, which is very encouraging for the Fed.
Right.
So we'll
Right.
see how this plays out, but I don't believe that the economy can really handle 4% interest rates, given how indebted it is, for as long as 12 to 18 months before the Fed's forced to cut.
Okay. So I want to bring in the BOC, the Bank of Canada, into the conversation as well, in terms of the aggressiveness that they've been employing as it relates to rate rises, or I think it might be aggressive for also an indebted country. What do you think? And in a hot housing market that we've seen for a decade.
Right. I think they're even more aggressive than the Fed, doing a 100 basis point meeting. And I think the Canadian economy is even weaker, or the trends are even weaker in the US, because we have over-leveraged consumers and we have a much weaker housing market than in the US. So I would expect
you said that the trends are sorry, Barry, the trends are weaker in Canada, not the United States.
That's correct. And
Okay.
so we have weaker economic trends in Canada, and we have an even more aggressive central bank.
How does that play out?
Not well, generally, for the economy.
And so, Barry, how do you want to position yourself then? I mean, do you become even more narrow in what you want to own and invest in, and make sure that you've perhaps liquidated other areas of your portfolio?
Yeah, well, I think, if you look at fixed income, and fixed income has two components. It has duration and credit. And I think that people should be avoiding credit because I think credit is the most expensive part of the investment. Credit is much more expensive than equities are here. The NASDAQ is down 20 plus so far this year, and high yield credit spreads are 100 basis points wider than they were. If you look, by historical correlations, high yield credit spreads should be 250 or 300 basis points wider if the NASDAQ's down 20 to 25%. So credit
All
is
right,
very
we'll be right back on
expensive.
that note. I'll be right back. Barry, just to go back to your last point in terms of credit spreads, only maybe about 100 basis points higher than the risk-free rate. You're saying it should be 250. Basically, what you're saying for our viewers to understand is that there's not enough risk priced into credit or the fixed income market, correct?
That's correct. I mean, both investment grade and high yield credit spreads have stayed much lower, closer to their historical lows. And if you compare that to the sell-offs or the negative returns in the equity markets, credit has outperformed equities significantly this year. And I think there needs to be some catch-up as the economy weakens.
It's interesting though, Barry, because there's a lot of people out there right now who I speak to who are positive towards credit. I mean, this is your area of expertise. They're saying go long credit, go long those, I don't know if it's going to be a loan market or what area of credit specifically, but they are positive towards it. And they do cite the fact that you haven't seen these credit spreads widen out. And the fixed income people, I thought, are always supposed to get it right. You're kind of telling me that the equity guys and girls have it right, not fixed income.
Well, no, I wouldn't necessarily frame it that way. What I would say is I think the risk reward of building a longer duration government portfolio is quite attractive now that 10-year bond yields are close to 3.5 and 30-year bond yields are 360 and 2-year bond yields are 385. I think those are levels that are going to slow the economy materially. And if the economy slows materially, credit spreads are going to widen while interest rates fall. And falling interest rates are going to be supportive of the equity markets, but they're going to be negative for credit spreads. So I'm keeping my portfolios I'm avoiding credit, high yield and investment grade in my portfolios and focusing on duration. Now, I have a very short duration right now because the Fed is meeting next week and we're not really sure what they're going to say. It's obvious they're likely to be hawkish. But I believe that there is a very, very large government bond rally coming, probably starting maybe even in the next couple of months. And if I'm right on the economy, you could see 10 and 30-year bond yields fall 150 basis points, which that's a 30+% return if you own a 30-year bond.
Wow. Okay. So to summarize for our viewers, there might be, according to you, there will be a nice opportunity to make 30% on 30-year government bonds at some point when you feel that the Fed has reached its peak and is going to have to start lowering rates, or rates will fall, correct?
Correct. Yeah, I think they'll be cutting by the middle of next year.
Middle of next year. It's hard to believe we're almost at the end of 2022. So mid 2023, you think they're going to start cutting rates?
I think they'll be cutting by that, and just as they were late to hike, they'll be late to cut, which that isn't different. That's held true in just about every cycle in the last 40, 50 years. and
That they're
the
late.
if
That they're late.
that
That the
they're
central
late
bankers have it wrong. That's what you're saying.
at both ends. They're late to do it because there's political influences, and they've got 300 PhDs that are advising them. And if you look at, they'd be better off having three PhDs because at least they'd have a consensus then. But nevertheless, I think that the market will be way ahead. Bond yields will rally way ahead of when the Fed starts cutting.
So then do you think, and we've only got about 30 seconds left, do you think then that when they start to lower rates mid-2023, that we should also start to see, significant equity rally as well? Mind you, if the economy is weak, it's going to be, I think you're going to have to continue to be very stock specific. But 15 seconds, what do you think?
No, I think the equity rally comes a little later. There's still some downside in equities from here as the economy
Okay.
weakens and earnings get revised lower.
Okay,
But
we'll take a
once
quick
the bond
break
market,
and we'll be right back. Barry, we were just talking about, from a strategy perspective, you think that an equity market rally is going to be a little bit delayed from fixed income rally mid-2023.
yeah, that's, because if the economy weakens, earnings are going to go down. And we've had a pretty significant correction in equities so far, but multiples are still average or a little bit above average. And in a weakened economy, it still needs to get cheaper. But eventually, lower interest rates will be supportive of the equity markets.
Okay. Barry, I want to get your take on one other key item that everybody's been focused on, and you and I have for so long. It seems now it's the talking point. And that, of course, is the strength of the U.S. dollar and what that does to, whether it's U.S. companies or exporters, other central bankers around the world. What's your take on the U.S. dollar, and how do we need to be thinking about it?
Yeah, well, a very strong US dollar is pretty much bad for everything in the world. Commodity prices are priced in US dollars. If US dollar goes up, that means commodities become more and more expensive for the rest of the world outside of North America. The US dollar is up probably 20% over the March lows. And the real question is it peaking now, or is there one more move upward in the US dollar? And I don't know the answer to that. I suspect we could have one more higher movement in the US dollar as the economy starts to weaken and the world kind of uses this US dollar as a flight to quality. But at some point, the US dollar is going to go in a multi-year declining trend. And that'll be very supportive of financial assets and economic growth in the world. But my fear
What's the
is
catalyst, though, Barry? What's the
the
catalyst to get the
catalyst
U.S. dollar
is
lower?
the Fed cutting rates. And when the Fed starts cutting, the US dollar is going to go down. Or if the market is anticipating the Fed cutting rates, the US dollar is going to go down because it'll be supportive of growth in the rest of the world. And, growth is pretty bad in the rest of the world. If you look at Europe and China, Europe's in an extraordinarily difficult position and is going to really, really struggle to have positive growth in the next year. And China's reporting GDP, the lowest in 25 years too, which means that economic growth in China is probably negative if you had real numbers. And that makes sense because China's going through a huge property bubble, very similar to what Japan went through in the late 80s and early 90s. And it's that big too. And Japan took, hasn't really ever recovered from that. I think China will be different because it's got a different form of government, and the capital they're willing to throw at it is different, and their labor force is more flexible. But the danger is that the US dollar has another 10% upside here, which would be very negative for financial markets, equities, and credit.
And it's interesting as well. We're short on time always, but it's interesting to take a look at the Canadian dollar and how weak that is, despite the fact that we, do have such a great energy industry in Canada. That's really, it's almost telling you that others in the world are very concerned about the Canadian economy, even though it doesn't quite feel like that yet.
Yeah, well, the Canadian dollar has outperformed almost every other currency in the world because it's correlated to the US dollar, and we've had a strong energy market to do that. But if growth slows materially and world demand for oil declines so that the supply demand imbalance goes the other way from what we've had now, there's material downside for the Canadian dollar.
Okay, Barry, we got to leave it there. Great to see you. Thank you.
You too. Good to see you.